Hi everyone, this is Rob Roy of Elliott Wave Options, and welcome to this trade review of our recently closed trade ID number 160 on BABA, which is Alibaba. It was in our impulse strategy, our directional strategy, and as you can see, we did a call vertical debit spread, and we exited this trade in just 2 days with just under 33% gain. One of the things that I always look at is if you can make 30% within 3 days or less, regardless of what your technicals are, you want to consider taking that gain because it's such a short-term move. Our entry, as you can look at the particulars of this position, was BABA was in a wave 3 with an eventual target up around 225 or so, and one of our primary confirming indicators, the DMI, was showing that this was a strong move. The ADX is in between the positive and negative directional indicator, and there's good separation between those two. So I like to trade the wave 3 when the confirming indicators are giving us signs that it's likely to continue, because obviously the difficult thing to determine in a wave 3 trade is when will the wave 3 end. So 2 days later, we make a nice move and we have a big bar to the upside. We were able to close this out at the top of that bar, and as you can see, we did back off towards the close. And then looking at the DMI, you can see that we were getting to the point where the ADX was close to that positive directional indicator. Now, once the ADX passes that, that's a sign that the strongest part of the move is over. One other thing to note about this trade is when we look at the chart of Alibaba when we closed it out with the A, B, and C move, and the target for the top of the C wave being at that 161.8% level, and we were very close. Normally within Fibonacci levels, Elliott wave, you actually will touch that line. So why did we close the position out when we were that close to hitting that point of resistance? Well, it's always important within Elliott wave to take into account the bigger picture, which is the market itself, obviously the S&P 500. And we've had a big, strong move in the S&P. And on the 20th of December, we had a bit of a doji there on the chart. So when you start to take a look at that, the big move that we've had, the prudent thing to do is to close your positions out with maybe a little bit shorter term gain, not let them run as much as you normally would have. Now, as we look back at this a couple days later, from a Monday morning quarterback standpoint, you can see that, well, here we go again. Elliott wave and the Fibonacci ratios did exactly what they were supposed to do, and we could look back easily and say, oh, we should have just hung in there a couple more days. But as I mentioned, take your profits, possibly a little bit on a shorter term basis than normal when the market is so extended itself. I hope that makes some sense to you and you found it informative. Look forward to talking to you again next time. Take care, everybody.